And a lot of the times people are just skating. They're just working really, really hard. And when they get to the finish line, it's a little bit too late to implement the necessary planning that could have taken place. That would have absolutely pumped them up into the right position.
Welcome to the Business Behind Your Business, conversations to help your business grow and thrive. Hi, I'm Paul Sweeney, founder of Pretium Solutions, Chartered Accountants and Certified Business Advisors, hosting the Business Behind Your Business. Welcome back to the Business Behind Your Business, and we're looking today at this whole idea of what happens when you retire, what happens when you sell your business, and are you going to have enough money available to live the lifestyle that you want? Now, it's a question that we get asked often when people are at the pointy end. They're at the time of selling their business and they realise that they may not get enough from the business sale to fund that lifestyle that they're looking for. Too often we rely on the proceeds from selling our business to live the life that we want in retirement. But there are other ways to do it. And, in Australia, we have the superannuation system, but it's not something that a lot of self-employed or business owners take advantage of. We're going to have a look at why you should be investing in your super as a business owner. Now, the best person I know to talk to me about superannuation is Jim Mills from Merit Planning. So, Jim, welcome back to the microphone.
Thank you very much, Paul. Very happy to be here.
It's good to have you back. And it's been a while, but this is a conversation that you and I have had off air a number of times, talking about superannuation and why business owners ignore it. And particularly around the whole idea of, when you come to sell your business, a lot of people rely on how much money they're going to get from their business. And unfortunately, we see that what's left after tax or from the sale is not enough. So the best method, I think, and we've talked about this, is superannuation. Can you just explain how that works, Jim?
Yeah, absolutely. So I think major part of the problem is that for self-employed people, we put everything into our businesses, and our business is plan A. And quite often they might push superannuation into plan B. But in reality, what we should start thinking about is that superannuation is absolutely a part of plan A. It's in partnership with your business, and it actually works with your business, and it's to actually, maximise your tax deductions. They build wealth in the most tax-effective environment possible. But, of the number of people that are self-employed in Australia, 10% are either sole traders or in partnerships, and they don't have any compulsory superannuation obligations. So that's part number one. Now, the 90% of the rest of us that are employed and in a company structure or as an employee of our own businesses, we're trying to pay ourselves as little as possible to pay the least amount of tax. So then if we apply superannuation guarantee across to that, obviously we start neglecting it. And the problem then does become that, with a lot of startups in this country and the amount of time it gets to be really strong from a cash flow perspective, you miss out and there is this major neglect that's happening in the superannuation space. And what people need to really be starting to think about is, what is the end outcome of what I'm trying to achieve here in my business, and what is going to be the most effective way for me to get to that specific number that I need that's going to then be able to produce passive income for me in retirement. And a lot of the times people are just skating. They're just working really, really hard. And when they get to the finish line, it's a little bit too late to implement the necessary planning that could have taken place. That would have absolutely pumped them up into the right position.
Yeah, and it's look, it's a hard conversation to have with somebody as they're retiring or about to sell their business about what could have been and how much they're not going to get. It's a heartbreaking situation to be in when somebody's invested 20, 30 or more years in business and they come to that situation and it's not going to deliver. It's not going to deliver. Yeah. They've been investing in running the business and saving tax, but not thinking of that end game of after they exit the business, what's the value going to be?
And 73% of business owners in Australia, they're aged between 30 to 59 years of age. So it's pretty even. 30 to 40, I think it's about 30%, and 40 to 59 is the remainder there. So if we took a cross section, right? Let's take a 40-year-old who might have 20 years left of working. Okay, let's say that they want, in today's value of money, $100,000 of passive income in retirement. Okay, so that would mean then we have to apply inflation to that $100,000 from today. So if we use the RBA target rate of between 2 and 3, and we apply 2.5% inflation on that $100,000 passive income, in 20 years it becomes $160,000 that needs to be passively created. And if we were looking to achieve like a 4% dividend passive income or 4% rental passive income off the wealth that they've accumulated, that means that they need to be sitting on $4 million in their super fund in 20 years' time to have a $100,000 lifestyle in today's value of money. So that's going to come from a variety of different things. There's investment return, there's taking advantage of contributions into the fund. So we know that year on year, anybody can use the concessional contribution cap of $27,500 and each year. And there's also non-concessional caps, personal contributions. So, each time an employer or a self-employed person makes that payment into their fund, they're creating a tax deduction for the business. There's opportunities there. And when eventually they do come to sell the business, they've got the small business capital gains tax rollover relief option, which allows up to $500,000 of that business sale into the super fund tax without it incurring any tax. The end game has to marry. So I did some calcs, and if that 40-year-old, say at age 40, he had a couple of $100,000 in super, and he, or she, I should say, and that's actually a good point for me to make too, because of all of the self-employed people in Australia, did you know 36% of them are actually females? And of the part-time managers in small business, 58% are actually female. So we should be proud as a nation of equal opportunity and growth in the self-employed space, that there's absolutely equal kind of representation happening there. So if this self-employed person started off with a couple of $100,000 in super at age 40 and they took advantage of the maximum concessional contribution over 20 years every year, and if they were invested in, say, a moderately aggressive kind of a portfolio that was achieving on average around about 8 to 9% per year, they would end up retiring on $2.3 million in 20 years. So remember that if they wanted to be on $100,000, they needed $4, right? So hopefully business sale pumps that up closer to that number, or they start realising that, their level of lifestyle might not need to be 100 if they've done the planning around it, So if we were to say that, the lifestyle was dropped down to $80,000 over 20 years, that becomes, just doing the calcs live as we have a chat, that becomes 127,000. Now, to achieve 127,000, we're going to need around about 2.6 million versus 4. Okay, so remember that 40-year-old with a couple of $100,000 was making those maximum concessional contributions every year. He ended up with 2.3 in the fund, and he needs 2.6. We're getting a lot closer now with a little bit of realistic planning about what to expect. But superannuation has to marry it. If all you're doing is working, pulling out the minimum amount of income that satisfies your, debt liabilities and your lifestyle expenses, and that's it, and the rest is sort of being gobbled up and not being planned for properly, you're just not doing the best you could do for yourself, and you're not thinking with the end in mind, which is why are we in business in the first place? Because we appreciate that we've got a higher earning potentially. We want to be the master of our own destiny. We want control of our lifestyle. But that doesn't stop the day you sell the business. And that doesn't mean that all of a sudden you're staring down the barrel of looking at Centrelink benefits after you've worked for yourself all that time. It just doesn't compute. So then like a more of an open mind and a passion for planning would go a long way.
And 2.6 million of accumulated super over 20 years is, I think, a lot easier to achieve than the alternate, which is expecting to get 2.6 million after tax from selling your business. Because I think, most small medium businesses won't achieve that. In fact, most of them won't achieve more than $500,000 or even close to $1 million, because we're coming to this situation where we have so many businesses coming on the market as people approach retirement. People are looking to exit, so we've got a surplus of businesses available. And when there's a surplus of businesses, you pick and choose as the purchaser which ones you're going to buy. So there's no guarantee as well that if you list your business for sale that you will actually sell it. And that's a trap. So there's two aspects to what we're looking at here. We're looking at the slow and steady approach, which is super, which is regularly contributing and making sure that we do that. So we're building up a retirement fund outside of our business.
Mm.
But the other one is looking at how do we increase not just the value of our business for a sale, but the saleability of our business.
Yeah.
And that doesn't happen overnight.
Big time.
Neither of these strategies.
Yeah, if you're thinking of the end in mind, Paul, I mean, they have to, they're hand in hand, aren't they?
Yeah. You can't just turn up and or the next day and think I'm going to sell my business for $2.5 million. There's a bit of planning that has to go in there. You have to create a business that's worth $2.5 million to somebody else.
Yeah, exactly.
They're prepared to pay.
So, I mean, we should pat ourselves in the back in Australia from what small business actually represents, because, did you know that small business in Australia adds up to 32% of our entire gross domestic product? Like 32% is what we represent, and we employ 41% of the Australian workforce. So I mean, we work hard. We are an integral part of this nation, and it's just so sad to see somebody working so hard. And the average self-employed super balance between age 60 to 64, I'm just looking at a study here from ASPA, it says $140,000 is the average. That's sad. That doesn't go anywhere to providing for somebody. Hopefully during that time they've nutted down their home loan. So this is the other mistake. We just concentrate on getting our home loan down. At the end of the day, we retire. Very little in super if we've been concentrating on the business, and then hopefully we're going to get that business sale. And as you said, what sort of economic environment, market environment, what sort of multiples can we expect in 10, 15, 20, 25 years' time whenever that sale point it comes up on the horizon? I think that retirement should be a time to be able to relax and sit back and know that you did a good job. And you did. All these people are doing a wonderful job, but if they're not thinking about the end with the end in mind, they're really staring down the barrel of something else. Let's not forget that 90% of small businesses fail within 10 years, right? Is that the statistic?
Oh, yeah, I think the statistics have changed, but it's fairly consistent from year to year. That is a lot of small businesses that don't last 10 years.
Yeah.
And then once you've lasted that 10 years, you've then got to have a business that you can sell.
Yeah, big time. And if you're not extracting wealth along the way and in the most tax-effective manner possible, you're going to get nowhere near what that sweet spot is in terms of wealth accumulation. And if you've been concentrating on super, this is what people need to remember always, is that in this country, under current legislation, if you're over the age of 60, fully retired, any income that you're earning or any earnings in your super fund are going to be tax-free, and any income you draw out is tax-free, right? So if we go back to that $2.6 million super balance that's giving you $130,000 a year, that's 5% sort of passive income. That's net income. If you had to factor tax into that, you're going to need more than 2.6. We're up to something like 3.2, right? When we factored in the additional tax. So superannuation is one of the most tax-effective measures for you to extract wealth out of your business for your retirement purposes, for your reward at the end of the day. And at the same time, every time you do it, you're creating a tax deduction for the business. Think about it too in terms of asset protection, which is a big deal for a lot of small business people. Superannuation is protected against bankruptcy. We're certainly not aiming for bankruptcy, but it's held separate from bankruptcy. So, if that number of business failures sort of stacks up and someone finds themselves in that position after they've been extracting wealth from their business into their super, it's 100% protected. So this superannuation mechanism is like the perfect marriage for a small business person. Of course, your cash flow and your revenue flows and your profit margin needs to be what it needs to be so you can start feeling comfortable putting that money into super and, that perception of having it locked away until age 60. Well, thank goodness for that, because that's when you're going to need it.
Yeah, no, I think when people start business, one of the last things they think about is actually paying themselves. And it should be one of the first things because, the business should be able to support not just your current lifestyle, but your future lifestyle. You need to be remunerated for your efforts, and you also need to be building up those assets outside of your business because, that business may not be there. Like we've got so many failures of business or closures of business, and it's not just because maybe business owner wasn't operating the business effectively. We've got things like changes of legislation or restrictions on what you can and can't do, or even technology changes. Look, we look at we've now got mobile phones. Pay phones don't exist. We've all got digital cameras in our phones, and there's nobody printing photographs anymore. It's
That's
all
right.
electronic.
Yeah, the death of Kodak is a pretty interesting story, right?
Yeah.
A massive company that just didn't move along with the times, and film development and for photos stops, and a huge company like that just goes by the way by, and it's over.
Yeah. So a lot of things can contribute to your business not succeeding or not being able to be sold. So we need to look at,
which aren't your fault. And you might have the perfect service proposition, perfect product proposition. If you don't have the right distribution lines, the right marketing, using the right technology, as you were saying, Paul, as well. Like, there's so many different things to get right. You have to plan. It's critical to plan in your business for any chance of success. I don't think you could fumble your way through an entire lifespan of a business without really doing a plan and surviving. Surely. I mean, maybe there's some lucky people out there who'll have a very simple kind of business concept, but I tell you what, without cash flow planning, without some distribution sort of systems and mechanisms, and without even knowing how to manage your staff properly and using all of the right efficiencies required there, profit margin doesn't exist, or it starts to get eaten away very quickly.
Yeah, I think there is a lot more to running a business than just turning up on Monday and opening the doors. And I think, we've talked about this, but I think let's drive home. There's three key aspects here that we need to address as business owners. I think the first one is we need to plan for our immediate business, so our 12 month to 3 year plan.
Yep.
But we also need to plan for our contributions to super to fund our retirement, or how we extract wealth out of our business. And that sort of ties in with that initial planning. And the third stage, which I see very few businesses actually do, is think about how they're going to exit from the business. Now, I often get told, no, I'm not going to exit from my business. I've got news for you. You are. Whether it's voluntarily or involuntarily, you will exit your business at some point. So you might as well plan to maximise the value of that. So there's a lot of planning that comes into maximising the exit price or the exit value and how much you get from retirement. And then there's strategies to actually maximise the tax effectiveness of your retirement. So,
absolutely. And the end game after the small business capital gains tax concessions, my favourite, of course, is the $500,000 rollover relief, which allows a business owner to put $500,000 of the business sales. But if you've got your life partner, as your partner in the business, that $500,000 becomes $1 million. If your life partner is working in the business with you, a lot of small business, you find that to be a bit atypical, not always the case, but that $27,500 a year you can put in from the business becomes $55,000 each year. You're really compounding the outcome. So that 40-year-old example I gave you, that was just assuming a single person, to get to that point. So if you're able to double up and utilize those rules along the way to sort of build up that necessary wealth component, you're setting yourself up for success, and you're doing it in a smart way. And of course, you've got to think about how it's invested as well. Because one of the other major problems with self-employed small business in Australia with self-managed super fund is the amount of cash sitting there doing absolutely nothing in the lowest cash rate that we've seen in history. So there's a few hats to put on, and you just have to knuckle down and realise that it has to be part of Plan A. It's not part of Plan B. And if your Plan A is your business, then superannuation is hand in hand the best thing you can start planning with, the long-term outcome.
Yeah, I don't think we can separate it realistically.
No.
Look, superannuation has to be part of your business operations. Your strategy for your business, it has to be part of it. We go into business to fund the lifestyle and the financial freedom that we want. We need to use all the tools available to us, and superannuation it's concessionally taxed. It's there to encourage you to grow your retirement benefits. So you should be capitalising on that as part of your strategy.
Other strategy involved in there too, and this just sort of even further kind of punches the point through. You're in business, you've built up revenue. It makes sense to buy your own business premises. Well, guess what? The superannuation laws and the current laws allow you to purchase business real property in a self-managed super fund environment, and you can operate out of it, right, for your business. So you're claiming a tax deduction for the rent. The rent's going into the self-managed super fund. It's only being treated as investment return and taxed accordingly. Tax in a self-managed super fund is applied to 15% on your concessional contributions, and any earnings is applied after expenses. So if you have a limited recourse borrowing arrangement in a self-managed super fund, and you are holding your own commercial business premises in a bear trust or a custodian trust, the debt repayment on that is an expense to the fund. Okay, so think about this. So you're making a concessional contribution every year, $27,500. A big chunk of that goes off to pay the debt payment on your business real property, and what's left over is taxed at 15%. After any other expenses in the fund, maybe life insurance or the tax accounting fees, etc. So your actual tax rate at the end of the day is a lot lower than 15%. So you're building wealth in such a most effective manner that you can imagine, and you're getting a tax deduction in the business at the same time, double actually, for the contribution that you're making as a concessional contribution, and also as an expense to your business for the rental income that you're capturing in your own retirement plan.
Yeah, and you're using the rent there to build up your own wealth, not somebody else's.
Exactly. The more you sort of delve into it, from a business owner's perspective, you have to start thinking about super. And the statistics suggest that we're just not. Our employees are retiring on average with nearly 50% more in their super funds than a self-employed person. We're paying them, so that should really tell a story that of neglect. And all it is because we feel like we're running on the treadmill with nowhere to go, and we're just trying to keep afloat. But if you're building contingencies, cash flow management, there is a point where you have to start squirreling away money and doing it in the most effective way possible for your outcome. Because I think, I have so much respect for small business in this country. As I said, we float this country. Without us, 41% of Australians aren't employed. So don't you think we deserve to be able to have our time in the sun, after all the hard work is done? And it's up to us, it's up to us. As much as it's up to us to run this country with 32% of its GDP, it's up to us to make sure that we don't damage ourselves and leave ourselves, without options at the end of the day.
Yeah, absolutely. Yeah, that's the reasons we go into business, to actually create that lifestyle, create those or enable those choices for us. So don't sabotage that by not planning and not contributing to super.
And I think I've had conversations with younger entrepreneurs, in the 30 band, and they have this perception that the super rules change so much that they can't depend on it for their retirement. They're worried that the politicians are going to be changing the accessibility rules or the tax rates and all that type of thing. They feel like there isn't any certainty there. So that might be another sort of mindset for people that are a little younger. But, all we can do is work within the current frameworks that are available to us now, understanding that a lot of the changes that get made, either aren't retrospective when those changes get made, or they're not meaning to undermine the purpose of super. Different governments will look at superannuation each budget as an opportunity to get more tax without that, because it's taxed so concessionally. So yeah, there's just thought around that, I guess. But you've got to, regardless of what happens in any space, at the end of the day, your superannuation is designed to be a much more tax-effective measure than any other component. And, in this country, even as it stands today, over 60, fully retired, it's zero tax environment. It's zero tax environment. That's an incredible place to sort of be building your wealth. I think it's fascinating. I think it's outstanding, actually.
Yeah, most people look into zero tax.
There's a Cayman bank account, but I don't think you're allowed to do that. So.
Well, I think the only other place you get a 0% tax rate is when you're not making money.
Right.
So super is the way to go, and the time to start is now.
Absolutely, right now. Yeah.
Great.
So I guess the other thing to think about is the pension balance cap. So when I say it's completely tax free, it's tax free up to the pension caps of 1.7 mil each. So that's to be technically correct on that. But that $2.6 million mark for a 2-person retiree kind of situation, husband and wife, or husband and wife, or whatever happens in the world these days. That's a completely reasonable outcome. And I have, majority of my clients are floating up in that space towards retirement, but they've had to do a lot of work to get there, and they have had a major focus on superannuation. You want to retire with anything close to what you need. You can't just rely on the superannuation guarantee payment. You've got to think about, if you're an employee, you've got to think about salary sacrifice. If you're self-employed, you have to think about extracting that concessional contribution up to the cap. You have to think about that. And as your business allows you to extract more and more personal wealth, the opportunity then is to start personally contributing money into your super fund as you get closer to age 60, because that's where you want it all to be. But if you don't extract wealth from your business along the way, you're just not setting yourself up for success.
Yeah, that's right. So I think you've highlighted there's going to be a couple of future conversations we need to have on the business behind your business, looking at how you extract wealth or how you plan to do that. So we're looking at this business planning and how much income do you need. And I guess the other one, which we really need to delve into, is how do you maximise the value of your business when you exit, starting now. So there are a couple of conversations that we're going to be having in the new year. Yeah. So looking forward to those. But Jim, thank you again for your time and your expert comments and encouragement to think about your future and think about using the incentives and the system that's available to maximise your retirement benefits.
Absolute pleasure, Paul. Thanks for having me on.
Not a problem. Always good to hear from you, Jim. Thanks.
Thanks for listening. Do you have a question you'd like our team of experts to answer? If you do, send your question to podcast@thebusinessbehindyourbusiness.com. To hear more from The Business Behind Your Business, don't forget to subscribe using your favourite podcast player. Or you can visit the businessbehindyourbusiness.com website.